Hello, hello. Are we live? Are we live? We're ready for takeoff. Hi, everyone. This is Ondine, and thank you again for joining us on this webinar, which is going to be Card Wars Episode 2. We will be reviewing the best practices in managing cardholder, well, not cardholder, processor and credit card expense and income. A couple of things. We are broadcasting live from Evanston, Illinois, from Burlingham Studios, home of my alma mater, Northwestern University. During this webcast, for those of you that have dialed in on the phone, you're not going to get the same impact as if you're watching it on a screen, because we will be doing polls throughout the webinar, as well as I'm going to be showing you some various documents that will be popping up, not just a traditional PowerPoint. Regarding questions, Elliot, come over here. This is Elliot. He's my wingman here, and he will be monitoring the questions that come in, and we will be going through the questions at the end of each section as well as at the end of the webinar. So, any questions? Is everybody good and ready to go? All righty. So, we're going to get this going. There's so much technology here, and I'm not a techie person. So, I just want to start off with episode 2. For many of you, you were here for episode 1, which went through the entire credit card program management best practices. It covered everything. We went through a whole lot of information. Based on a poll that I did on the last webinar, it seemed the one that people wanted to see the most was managing the income and expense, and I am your person to get you to where you need to be with this information. So what we'll be going through today on the agenda is income management and the 3 sources of income on your card program: finance, charge, interchange, and fee income. And then the expense management, the key categories you should be checking, your expense rankings, what tends to be the highest expense in a profitability analysis versus the lowest, and then finally the nitty-gritty with the processor invoices. One more thing before I get started. You'll notice we're in a plane in the background. Not next month, in October, because I love this plane background, we're going to be doing another webinar about reward and loyalty programs, and we're going to have a special loyalty expert, Andrew Gates, and we're actually going to be sitting in airplane seats doing this, so it should be a lot of fun. So we're going to move on, get down to business here. Those of you, I want to remind, and this is just good information to practice overall if you are new here, but when we are talking about credit cards, I want everybody to focus on the fact you don't want penetration goals. And the reason that I'm putting this into an expense and income webinar is the accounts on file cost you money. Where you make money is basically on your credit card loans. Therefore, I've been recommending for years that credit unions should be establishing their credit card goals based on dollar amount. Forget about the number of accounts, because the reality is the excess accounts on your system on all of the portfolios that I've analyzed over the past 13 years tend to be anywhere from 35 up to 50% of the accounts that are either dead, lost, stolen status. So as we go through this, make sure you're remembering to focus your credit card goals on total loans. Now, with that being said, ideally you want your credit card loans to represent at least 10% of total loans. Now, the national average actually for credit unions, according to NCUA, at the end of 2016 was 6.5%, and that's actually been dropping. It used to be up closer to 7.5%, now it's down to 6.5%. But again, as we all know, just because that's the average doesn't mean that that's ideal. So in order to maximize credit card earnings, if you ever want to know the reality of what your card loan portfolio should be, at least 10% of total loans. Some of the higher performing credit unions actually have 15, 16, 17% of their loan portfolio is in the unsecured credit card market. The other thing that we're going to keep in mind as we go through all of this in the next hour and a half is your annual net income per account. I am the kind of person, I don't like ratios because I think ratios can be very deceiving versus the dollar amounts is what actually can make the impact. Keep in mind that as we go through this, your annual net income per account on file should be at least $75 or more. Now, I have clients that actually have annual net income in the $200–300 range, but it should be at least $75, and it's a good rule of thumb to keep that number in mind before you were to implement a reward program or anything like that. So, here we go here, again, the annual net income per account, and I'll be showing you a spreadsheet in a few minutes, and anybody who's on this webinar, I've created portfolio analysis sheets for each processor. So whether you process with PSCU, Vantiv, FIS, TMG, Co-op, if you're passed through with Jack Henry, I've got spreadsheets that I can send to everybody after the webinar. Just send me an email and I'll send those off to you. But these are the sheets that I use for my clients, and it will help you calculate all of this information so you know that you're actually calculating. And it's fun to calculate individually your rewards program versus non-rewards versus secured, the whole bit. But I don't want to get too far off track. Regarding income categories overall, the general rule of thumb is you get your income from 3 sources with your card program. It's finance charge, interchange, and fee income. Finance charge should represent at least 70% of your total card program revenue. Interchange should be 15%, and fees should be 15%. Now, I want to make a little side note here. I'm going to start getting a dry throat again. A side note, excuse me, the interchange on individual programs, clearly on a reward program, the interchange will be higher than finance charge income. But overall, when you're looking at your credit card portfolio with all the numerous programs you may have, overall, this is what you want it to look like. And we will go through how to calculate those in each individual item throughout the next few slides. This is a basic formula. You can either take pictures of this screen or when you get a copy of the webinar after this is done. But this is actually what I do at my credit card schools is we have the credit unions get your year-to-date numbers. And even if you just want to do the entire portfolio instead of individual programs at this time, but find out what your finance charge, interchange, and fee income, and then calculate the ratios, see if you are in that 70% finance charge, 15% interchange, and 15% fees. This happened before, I'm sorry. Something else I want to share is don't analyze your portfolio in isolation. And don't do it in a vacuum either, and I am talking about finance and collections. And I don't mean to be, well, I typically am very direct, but typically, if something goes awry with a card program, let's say charge-offs all of a sudden go high, well, oh my gosh, we've got to increase rates. We need to put a penalty rate in. Thank you. And numerous different things, but what I want to be able to show you during this webinar, before impacting the member by changing the fees or rates, I bet there's a lot of things you are not doing internally with your card management where you could be saving a lot more money rather than going after your members with increasing fees or things like that. So we will be discussing the APRs and rates, whether it be non-variable, fixed, I still call it fixed, and variable rates. Your average credit line, would you believe the average credit line is less than $5,000 for credit unions? It's horrendous. And if you really want your program to be profitable, you need to have an average credit line across the entire portfolio of $7,500 to $9,300. And now with that, you've got your average balance. You need to have an average balance of $2,600 minimum. If your average credit line is only $4,000 and your average balance is $1,300, there's a very slim chance your program will maintain profitability over the long haul. You need those balances, again, because it goes back to 70% of your revenue should be coming from finance charges. I'm going to touch on the fact that our profitability model, and when I say our, I mean the credit union industry for credit cards, is very much different from the bank side. So we don't want to be mimicking the banks, or the bank has this fee, it works for them, or banks do 0%, it works for them. We can't do that, and I'm going to get into that over the next hour as well. Your usage rates, and all of this is tied to profitability and managing the income and expense, should be at least 65% of your entire portfolio. Your credit utilization ratios should be less than 30%. What I've been seeing, and it's getting a little better, but a lot of credit unions were very hesitant to do line increases in the past because of the verification of income requirements that came from the CARD Act. But the reality is most credit unions that I've worked with in the past couple of years have credit utilization ratios above 40%. When your credit utilization ratio is above 40%, and for those of you who don't know, you basically take your average credit line, divide it into the average balance, get the ratio. But if it's higher than 40%, it's an indication that you need to review your portfolio to give line increases for qualified cardholders. Because the bottom line, what that number is telling you, are your members don't have enough space to be using the card, bringing balances over, or even generating transactions. The fee parameters. Have you ever done an audit on your fee parameters? When I do work for my clients, I find them tens, and sometimes if it's a big credit union, hundreds of thousands of dollars annually. And we're going to talk about this. This has to do with parameter settings with your processor, making sure that you did the right things after the CARD Act. And then the reward programs. Is it profitable? And you want your reward programs to be bringing in annual net income per account of at least $75. There is no doubt that reward programs, as a side note, it does increase interchange tremendously. And for example, if you have on your reward program and you break down the income ratios, you may find that 45% of the revenue of that program is coming from interchange. But where it starts coming down, it still will not be as profitable as the other program, which is focused on bring your balances over, the whole bit. We'll talk about that too. Here, I've got to do something fancy technologically wise. We are going to display here, let's see this. Oh my goodness, bear with us. Do you guys see this? I really need somebody to click a yes or something in the chat box, but what I'm displaying here is a spreadsheet. Somebody? Yes? Okay. All right. Earlier I was talking to you about the spreadsheet that I do for my clients. And this, as I mentioned, I'm going to send one to each and every one of you. You need to email me and tell me who your processor is so I know what to send you. What? Oh. Okay, if you see something that says handouts on the right side of your screen, click the Sample Credit Union Completed Sheet Phoenix. So what I'm going to do here is I'm going to page down, and I want to show you this line item here, number 169. This credit union was over $1 billion in assets and among other things, and I could actually spend an hour just walking you through this sheet, but we don't have that kind of time on the webinar. But I want to show you the net income per account for their student program was negative $24. Their Platinum program, $148. Their Affinity program, they were losing money. Their Platinum Rewards program, they were losing money. Their World Card, they were making $30. Their Business program, they were losing $6. And if we go over to the overall profitability in column S, row 169, they were making $67 in net income per annual account. This is a great sheet. I love this sheet. I'm very proud of this sheet. I've used this, and it tells you everything you need to know about your card program. But I want to take you up to this top-hand corner, rows 6 through 10, and columns Q, R, and S. This was a credit union that was $2.1 billion in assets, and they had 43,000 accounts on file. Look on row 21. Yet, we're going to scoot down here to where it says debit active accounts, and it's not debit active. They're not debit accounts. They're actually active accounts. They only had 17,000 out of 43,000 accounts that were active. So do you think this credit union would be paying a little too much by not managing their card program? I used to really gang up on the processors for saying, you know, you're charging everybody for these inactive accounts, but the reality is a lot of this comes back to the credit union and whether you have somebody properly managing the program. Okay, we need to lose the sheet now. Does anybody have questions? Oh, we'll get to questions in just a minute, and then Elliot's going to read them off. Have any questions come in? Okay. Quiet bunch. All right. Where are we? Okay, here's the section on profitability, credit unions versus bank. There's a reason that our programs are different, and don't try and imitate what the banks are doing because we are not built that way. We don't take the risk that banks take. We don't have the $20,000 credit lines. But with banks, they typically rely on finance charge income, 30% of their income. They don't really care about balances. They care about interchange and they care about fees. And because their bank model is 30% finance charge income, and they do charge, for example, for those 0% balance transfers, they charge the cash, not the cash advance, yeah, the cash advance and balance transfer fees. They get a lot from interchange because of their high credit lines, and their fees, we all know that their fees are a lot higher than ours. So when I tell you not to do cash advance fees, not to do balance transfer fees, not to charge a separate APR, don't do penalty rates. This is that lady on that commercial is no, 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 this is not how this works in the credit union world. So just stick with me here. So we've gone through the overview so far. Does anybody have any questions so far that we can move in? And I think we've got the ability where you can talk live. Where would I see questions? No questions. All right, no questions. Moving right along. I'm going to ask everyone a question. Are you bored? Are you bored? What airline are you on? Thank you, Andrea. I'm on Card Wars Airline. All righty. Finance charge income. All right. This is where Ondine is going to talk about rates. I will tell you, when I do my credit card schools, I will basically do these polls at my schools, and I'm going to start doing them at these webinars too. But this is the bottom line, is back when the CARD Act went into effect and after the 2008 recession, the credit union industry, as I like to say, got their knickers in a knot. Everybody panicked, and we took away, the majority of credit unions took away the one feature that made our card programs more competitive than banks. Because back then, we did not have competitive reward programs, but we did have fixed rate cards that banks didn't have back then. So we all went to variable rates, and my big question is why? and the non-variable can be a boom to finance charge income overall. I do want to tell you more credit unions are coming back to fixed rates now, and this is the kicker. And for those of you that have been around in the credit union industry as long as I have, I've been in this industry since 1985, and way back when I worked at Baxter, and this would even be going back to the 90s when I ran their card program, we were basically, and this is my argument for fixed rates, and I want everybody to listen very carefully. Credit unions as a whole, when we were all fixed rates, is we would risk-base the price, we would risk-base price the credit card portfolio and assign the rate to the cardholder based on their score. So we would manage the risk of our card portfolio according to the risk of the cardholder and not the economy. Okay, so we're having some changes now, and all the prime and all of this is going up. Well, guess what? Who's going to get more ticked off when their rate increases over something they can't control, which is the economy, versus if you do a fixed rate and you score cardholders at reissue, the members will be more accepting that their rate has gone up. You grandfather the old balance, just like we used to do. You would grandfather the old balance at their old rate, any new charges. And what people fail to understand is the credit unions were in compliance with the Card Act before the Card Act took effect. We all went to variable rates. We took away that one benefit that kept us very, very different from banks. But there are some big credit unions out there now, and I'm finding more and more. We've got Michigan State University has fixed rate programs. Go to their website. Purdue University Credit Union has fixed rates. Unify Financial in California has fixed rates. I'm seeing them more and more. So we're going to do a quick little poll here, and I'd like everybody to participate. And we are going to say, and when this is done, you have a minute to answer, well, like 30 seconds to answer. We're going to show the results. But here's the poll. Are your card rates fixed, variable, or both? Woohoo! Okay. All right. Help me, Elliot. What do I do now? And this is anonymous, by the way. So if you're doing something I don't like, don't be ashamed to say I can't see who's answering what. Close. Show poll results to attendees. Share. Okay, here are the results, and we have 27 credit unions in this webinar. So this is actually good. We've got 37% that are fixed, 21% that are variable, and 42% that are both. And I love seeing that, and what I would suggest as we go further on is that if you're offering both, please ensure that the variable rate would be on your rewards program and the fixed rate on the non-rewards program. Believe it or not, I've seen it flip the other way around. Not quite sure understanding why that is, but we'll go through that. So moving right along. Where are we? Ultimately, the interest rate is just one factor of the success of any card program. Yeah, this is what I want to talk about. Everybody gets so hung up on rates. Oh my God, what should the rates be? Sometimes I think the CFOs are trying to justify their existence. But when you look at the profitability with my analysis that I showed earlier that I will send to everybody if you tell me who your processor is, all of these things have an impact, and mismanaging one of these could ultimately impact your entire portfolio. But profitability is affected by your charge-offs, your appetite for risk, meaning your credit line management, your program expenses. Are you managing them? Is somebody in the office managing them? And wait until we go through some examples in a few minutes. Your fee income, is that being managed? And then your marketing expenses, sometimes those are getting out of control. So to maximize your program's overall, excuse me, potential. You need to look at everything, not just get hung up on the rates. And in my card manual, where's this? Here's the Card Wars manual that I do at my schools, which is 250 pages. There are examples in there that actually show all the different things about managing these expenses. So here's another one. Remember we were talking about rates, and I love this one because it makes me feel really smart, and it makes people feel sometimes like, oh my God, how could we not be doing that? You need to find out, are you scoring your cardholders at reissue, let alone are you scoring them at all? And the bottom line is you have a choice. You can measure the risk by the economy, which I went through before, and have upset members when the rate increases, or you can manage the risk by the cardholder and have more satisfied members. If they've gone from an A to a D, they know they've screwed up and they're more accepting of the rate. But then the bottom line question is, if you have not scored your cardholders in the past 5 years, you're not risk-based pricing. And I can tell you, you may have it on your website, you may have it on your terms and agreements. Your rate will be from here to here, depending on your score. And I do this poll at my schools, and maybe 20% of the people at my schools score, and they're like, oh my God, we don't score. Well, if you're not scoring, you're not risk-based pricing. So we're going to launch another poll. This will be fun. And again, this is anonymous, but it'll give you an idea, and be honest. And if, where do I go here, Elliot? Do you score your card holders? Do you score them annually, at reissue, not since account opening? Won't this be fun to see this one? And when we get to the Q&A, I want a credit union out there to tell me why you're not, and not in an attacking way, but perhaps is there something Undine's not getting? Okay, we are going to close the poll. And are you ready for this? 13% score annually, great. 19% at reissue, and 69% have not scored since account opening. Okay, so take that to your CFO and say, you know, what are we doing here? And I mean, just it goes with the fixed rate, everything. And it's something, to be honest, I'm surprised the NCUA hasn't brought up in different audits, but that's very, very interesting, kind of goes along with what I see at my schools. So regarding building the balances, all right, as I mentioned, you need to have a fixed rate program. You need to have strong credit lines. How do you get the balances over? Well, this is kind of not rocket science. But you need to offer a fixed rate non-variable option, make it balance driven. You need to make sure the credit utilization ratio for that program is less than 30%. If you have not seen growth in your portfolio in the past couple of years, I can almost guarantee you from experience seeing other credit unions that I've been analyzing that their credit utilization ratio is 40 to 50%. So you may have marketing wanting to do all these promos. You've got somebody in lending or operations who's not managing the credit utilization ratio. Well, all that marketing dollars are going out the window. It's one of my biggest pet peeves too, and I talk about this in the school. And I don't mean to offend any marketers out there, but marketing should not be marketing credit cards if they do not understand the analytics of the portfolio. That sheet I showed you earlier, that can basically be your tea leaves and your answer for your marketing plan for the following year. Everything you need to do for your portfolio marketing-wise will be in that spreadsheet. Running out of, I can't see a whole lot here. Okay, I've got some balance transfer campaign rules. Never, ever, 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 ever make it an ongoing introductory offer. When you do a balance transfer, you want that immediate action with a start date and an end date. And I'm not going to go into much detail here because of time, but just trust me on this. It's in my manual. It's discussed at my schools. You can call me after. The only time you should be doing balance transfer promos is January through March of every single year. Don't do them other times. They're not going to be as beneficial overall to your portfolio growth. The promo balance transfer rate, you don't need to do anything, I say, but I recommend that you have that end on a set date, typically December 31st of each year. So when you do your promotion and your marketing people are out there, you want to be able to say, hey member, if you transfer your balance before March 31st, 2018, we're going to give you a rate of 2.9 until December 31st, 2018. Then you're set to cycle again. And don't ever, 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 and I know some of you have, offer the 0% balance transfer. Our model, as I mentioned earlier, does not support this. I have seen credit unions do it. They do get balances. There is no doubt they get balances, but they're only temporary. And then they have this big shrinkage. And then, you know, bottom line is, do we want cardholders like that who are just focused on transferring? And I've actually seen the credit unions that do those lower rates, 2.9, 3.9, 4.9, they do keep those balances a lot longer. Okay, we are going to move on to fee income. 15% of your revenue should be coming from fee income, okay? Now, this is a big one I've been seeing the past couple of years, is credit card late fee income is decreasing among credit unions, and nobody is checking this. And I am not saying that you, God forbid, no, don't do this, don't take it out on the members, it's not their fault, it's typically the credit union's fault. Excuse me. But it was an overlooked residual effect of the Card Act. And here's the bottom line. I think, yeah, basically, the Card Act does not allow you to collect more than the minimum payment. So let's say, for example, your minimum payment is 2.5% or $15, but your late payment is $25, and you have late members. Well, guess what? You're not allowed, and your processor is required to set it up this way, but you are not allowed to collect the $25. You can only collect the amount of the minimum payment, $15. So, you know, all of these things about, well, it might be up to $25. If you have that terminology in your disclosures, you can get rid of the up to. You can make it 25. It's typically tied to what the minimum payment is. And the credit unions I've worked with, when they change this, it's like, oh my God, we have seen our income. Now, wouldn't you rather do something like that than go out and charge rates and additional fees to members? So I want you to check this out. And by the way, at the end of this webinar, I've got a list. I think it's a list of 10 items. It's basically your homework. These are the things you need to do based on this webinar. So, Tim Green, what are your thoughts on, can we hold that till later, if you don't mind? Oh, you know what, I'll answer it now. Tim is asking, what are your thoughts on life of loan balance transfer offer, low rate until balance transfer is paid in full? No, you got to have it a start date and an end date, because you could have that on your books forever. You're going to have that rate taken up forever. Those life of balances are very, very dangerous. I wouldn't touch those with a 10-foot pole. It tends to make the portfolio on the back end very, very messy. But if you have more on that, Tim, you can always call me. We can discuss it later or at the end of the webinar. So going on to this minimum payment, this is an exercise. You can take a photo of this screen if you want, or again, use it when you get the webinar copy. But have somebody find out what your late payment dollar amount is. If you've got your disclosure handy, look at it. Find out what your minimum pay percentage is and what your minimum pay dollar amount. And the simple thing is you want them to match. And if your minimum payment is lower than your late payment, you need to up it. You don't have to up the percentage, but you have to up the dollar amount. All right, your late fee income. Again, another way a lot of credit unions are missing late fee income. Are you still charging the late fee because you're a credit union at 10 or 15 days beyond the payment due date? Or you're doing 10 to 15 days because that's what it is with consumer loans. I would much rather see credit unions tighten up that grace payment day rather than increase fees, add fees. Just bear with me through this presentation because I'm going to show you how your program can be profitable. You really should only be charging 3 fees, period. So you basically talk about, or I'm telling you to change the parameter rather than increasing the fee. This is a good one too, and I've had this happen before. What you think your disclosure says and what you think your processor has in their system may be completely 2 different things. I've seen parameter errors where the disclosure is saying it will collect after 5 days, but gee, somehow the word didn't get to the processor and the system is still collecting it after 15 days. So I'm going to show you how to do a late fee income audit, and that should be done on your card program ASAP, because the good thing about the timing of this webinar is get things in line for 2018. Again, I'm just going to constantly talk about maximize your fee income via parameters, don't take it out on your members. So what we have here, oh, I'm going to show you another file. Where is this going to be? Handouts. The handout we are going to look at is the 10-day grace late payment JPEG. Okay? This is out of my training manual, and from my training manual, it was actually one of my clients. But this credit union had, and this goes back to 2007, but they were still charging $20 at 10 days beyond the payment due date, and they only collected $41,000 for the entire year by that 10-day, but they were missing a huge opportunity in the delinquency numbers between 5 and 10 days. And so we calculated they could have collected an additional $102,000 more. And then if they were to increase the $20 to the standard $25, reduce the payment down to 5 days, they would increase their late fee income up to $128,000 from $41,205. So that's a pretty big deal and something that I am always stressing. So I'm going to do a poll here. How do we get rid of that? Are we having fun yet? Sorry about all this technology. I'm trying to make it interactive. Yep. Okay, so this poll is, how many grace days do you offer before assessing a late fee? Oh my God, don't tell me this. Oh no. All right, you guys have work to do, and I'm going to be yelling at you later. Because okay, all right. Just about to, 65% voted. Come on, the other 35% of you. It's anonymous. I can't see who's voting who. No one can see that. Okay, closing the poll. Share. Okay, here are the results. None of you are charging at 1 day. 28% of you are still charging at 15 days, 22%. So we've got 50% of the people on the webinar charging at 10 days and beyond. I like the fact that the other 50% are 5 days and below, and I'm actually very impressed with the 6% that are doing 3 days. Okay, to those of you, it's all anonymous, I can't see this, but to those of you who are still at 10 and 15 days, I'm going to tell you now, you need to get your disclosure, and if you're charging all of these other miscellaneous fees and thinking that you need to maximize your fee income, this is what this is all about. Stop taking it out on the members. And I know we want to be nice and everything, But if push comes to shove and your program is not profitable, this is one of the easiest areas to manipulate without having such a detrimental effect to the member. Where are we going now? This is a biggie. All right, stick with me here. This is one of my clients, and I've got to look over on this screen, so bear with me. This credit union converted from one FDR processor to another FDR processor, full service. And I was hired to do an analysis of their entire program, and I did the late fee income audit like I'm sharing with you. And they had 862 late charges in the month of December. Yet they only collected $2,045 in 1 month. So look at that average there. When I calculated the average for the Visa Diamond program, they collected $188, but they had 66 late charges. Well, guess what? It was at $25. It should have been for that 1 month, $21,000. So the potential annual missing late fee income for this credit union was over $200,000 a year. Now, to put this in perspective, because I know it seems like a big number, this was a $1 billion credit union in the Northwest, and they had converted, but this happened to be a parameter setting error. So again, I want everybody to check their parameters with their processor if you're finding that your late fee income is not where it needs to be. Over limit fees. If you need money, if you are not at the annual net income of $75, you can consider over limit as an opt-in. And especially, okay, first of all, the CARD Act allows you to offer over limit as an opt-in only. And I do suggest it for those credit unions who have courtesy pay on their checking, because basically it's the same process. So if your members are used to that on the checking, might as well offer it to them on the credit card if you need to. Now, having said that, guess what? The processors, and I've learned this at my schools, they don't have the capabilities of actually doing opt-in at the cardholder level. It's not to say that the in-house on your core system you may be able to do it. That could be iffy too. I'm not crazy about the lack of some of the core systems abilities with credit card management. But I'm going to be pushing for this more and more with the processors, because it is a ton of fee income that is being left on the table, as you know, even from your overdraft income. But we're going to scoot over here to the next slide. And this is the credit union, actually the same one. They had 507 accounts that were over limit at the end of December 2014. And if they were to charge those $25 per account, you do have limitations with the CARD Act. You can only charge one time a month, and the member does have to opt in. That's $152,000 a year. When we lost over limit fee income, it was a huge, huge, what's the word I'm thinking for? Detriment, I don't know. Word escaped me. Menopause does crazy things to us ladies. The foreign transaction fees. When I see a credit union that has marked up their foreign transaction fee, it irritates the heck out of me. Basically, these fees, we pass them on to the card holders, we being credit unions, because that's what we're charged by Visa and MasterCard. I'm sure some of you are hearing some of the banks are eliminating foreign transaction fees or promoting it. You don't have to jump on that bandwagon. I think this is a very unique situation for credit unions that may have an international membership, military credit unions. You know, if you know that your members are overseas and are impacted by foreign transaction fees, first find out how much you're talking about giving up if you were to eliminate them, and make sure that it's worth it. But it's a fee that's there. My general rule of thumb is, as long as it's just passed through, I've seen credit unions do 2 and 3%, and I think that's a sin. They're edging up in the wrong areas. So we're going to do another quick poll, and this one is, did I go to manage polls? Oh. Okay, and I've got a typo here, so excuse me. It's not wave like this. I know it should be W-A-I-V-E. But do you waive foreign transaction fees? I bet most of you are going to say no, but let's see. Okay. We're going to shut down. 5, 4, 3, 2, 1, close. Share. 63% of you do not waive them, and 32% of you do waive them. 5% are thinking about. I'd like to hear those of you that are waiving them. I'd like to hear your thoughts on the message board or the question and answer session. Are you an international member or military credit union, and do you find it has been helpful? Because I'm still trying to figure that out myself. Thank you for taking that poll. Oh. Okay, so fee no-nos. Don't ever do a cash advance fee, and don't do higher cash advance APRs for that matter. And there's a simple rule for that. Cash advances start earning interest from the day they're posted. They have no grace period, that 27 to 28 grace period that purchases do. So you're already making more money on them. That's just something banks do. Don't be charging balance transfer fees. Don't upcharge foreign transaction fees. And how many of you still have on your disclosures those lovely, lovely disclosures from LoanLiner? Wait till you come to one of my schools what I have to say about those. But if you still have statement copy fees, documentation copy fees, anything that you're charging for, yeah, you need to be updating that a little bit, because my gut is if you have online access or your members have online access to their card program, they can do it themselves. So the less fees you can be having on your disclosure, the better off you'll be. And this is what I was mentioning earlier. The 3 fees that you should really be focusing on is the late fees, the return payment fees, and then the foreign transaction fees. Now, I will tell you the return payment fees, that's another area. You may be listing in your disclosure that you charge $25 for a returned NSF payment fee, but I find that most credit unions aren't even collecting it. Somebody forgets. It tends to be a manual process. If you don't have the correct parameters set up with your processor, they do have the ability to make it automated, but many of the credit unions don't take advantage of it. So if it's a manual process, the question is, you may be charging a list of miscellaneous fees. Are your employees even collecting it? And what I tend to find is no, they're not, because they're so busy doing everything else. So the 3 definite fees here are the late fees, 25 at 5 days, reduced to 3 days in the future, but you don't do it unless you need to. That goes back to the overall profitability. Your return check fee, source of missing income for many, foreign transaction fee. The maybe fees, and only if you need them, would be an annual fee for reward programs avoided on secured cards. And I do suggest, see these states here, California, Iowa, Colorado, Massachusetts, sometimes they have state laws. Well, not sometimes, they do have state laws. And in California, if you're a state chartered credit union, your late fee can only be $10 at 10 days or $15 at 15 days. So they have some extra things to make up here. So I do see in California more annual fees than I do in any other part of the country. But Iowa, Colorado, Mass, they all have those rules as well. Over limit fee opt-in per the Card Act, and the balance transfer, 0. So we are, any questions coming in, or?
It looks like we have some people who do have foreign or have waived foreign transaction fees, but those are
Oh, thank you. Tim says we have, and this is they waive the transactions. Tim, I love you asking all these questions. We have members in 49 countries, single seg credit union with huge international presence. That makes perfect sense. Patty Davis, I think Patty's from Eastman. We just began waiving the foreign transaction fee several months ago to become more competitive with national. And we are 3.8 billion. Yep, that makes perfect sense. Andrea loves Card Wars. I love you too. Okay, so, and Andrea also says that Uncle Credit Union out in Los Angeles, they are the former Lockheed Federal, they have a fixed rate. So there you go. I mean, if old Lockheed / Uncle has it, and I respect that credit union greatly. Okay, we're going to talk about interchange income. This is where it's going to get very tricky. All right. Where are we? Interchange. Let's have a chat about interchange. The thing with interchange, first of all, to give you a range, it's not like debit. Gross, and pay attention when I say gross, credit card interchange should be 1.68 to 1.72 of net sales. Now, we put an awful lot of stock and faith in our processors because interchange often comes through as a single line item on our invoice, or if it's the invoice or the interchange report, it's like, okay, our processor said we got 123,000, I guess that's what we got and we'll book it. Wrong. So, never assume that your interchange from your processor is gross. I can tell you right now, 5 out of the 7 major processors give you net interchange. They're not hiding anything. They're putting it on the invoice as net interchange. I mean, the description actually says net interchange. So what does this mean? It means that the settlement fees that were charged to the association by Visa were already taken out. Now, I'm a very detail-oriented person, and I don't know about you, but if this is my member's money and this member earned money on interchange, I don't want to know what the net is. I want to know what the gross is. I want a breakdown of the fees, and then I'll book the net. So I can book the expense, I can book the, I can book the credit, I can book the fees, and then I'll come up with the net. And because it's often a single line item on the invoice, there is no other detail. So this is a question. Highlight this or make a note. Do you settle directly with Visa or MasterCard? I seriously doubt it, because in your processing contract, that's where all of the settlement wording will go. And just bear with me, because I'm trying to make this as very simple as possible, but it's going to give you a lot of insight into this. Hold on. I'm going to take you to this next slide. And this is what affects interchange payment. So never, ever, ever make assumptions, but this has to do with your brand affiliation, okay? You want to determine what your classification is with either Visa or MasterCard. And the reason this is so important is this impacts interchange, expenses, pass-through fees from Visa and MasterCard that are often those single line items, single huge line items on your invoice. So call Visa or MasterCard directly and do not rely on your processor. And I say that from experience because I've got a $2 billion client in Texas, and they were this processor's largest client, and this credit union has been a client of mine for 10 years, basically right after when I started my business. And I used to tell them, are you sure you're a principal member of Visa, or excuse me, of Master? Oh yeah, yep, our processor has told us and reassured us, and yes, we are. And I knew from looking at the reports and the settlement that something wasn't quite right. Well, it took us 3 or 4 years, and then the credit union was finally listening to me. They thought that I just was, Andine, what are you talking about? So I was down on site. We called MasterCard directly, and I said, you know, I want to know who this BIN is licensed to. I'm here with XYZ Credit Union. And sure enough, the BIN was licensed to the bank of the processor. And this is a huge credit union. So I've seen this happen. I'm not saying that they're being untruthful, but you cannot make assumptions here. So you need to find out if you are a principal versus an associate or affiliate with MasterCard or Visa. The next thing, who owns your bin? And this is another thing, because you may think you own your bin, but it may be the processor and or association that owns it. You need to get a copy of your credit union licensing agreement from the brand. And then the next thing is, do you have a brand agreement? There's a lot of money being given away by Visa and MasterCard, brand flips, but it's not really the topic for this, but I just want to throw it out there. The advantage of if you own your own bin and ICA, you don't have to worry about your interchange. You can call Visa or MasterCard directly and say, hey, I'm XYZ, here's my bin. Can you tell me what the interchange was that I earned in XYZ time period? And then compare it to what the processor's giving to you. But if you're an affiliate or an associate, that's not going to be so easy. So I want to do another quick poll. We are going to say, what is your membership classification with MasterCard or Visa? Associate, affiliate, principal, no clue. Okay, we're going to shut this down. Close. Share. Okay, good. 20% of you are associate. Well, that's not good, but more of you are principal. It's okay for those that have no clue, and 20% are associate affiliate. My only recommendation, if you're principal, is make sure that you know that you're principal through a conversation with MasterCard and Visa and not hearsay, not because somebody else at the credit union told you or not because your processor told you. Truly want to make it verifiable directly with Visa or MasterCard. So the thing with owning your own bin, you will likely be dissuaded, and because most of you, well, we're not even on that one. Wait, don't go yet, Elliot. I want to do one more poll. I'm going to do one more poll about, do you own your bin or your ICA? And just take a minute, and it's okay if you don't know this. I find people at my schools don't know this. Okay, we're going to close this one quickly. All right, close. Share. So 84% of you own your bin, 11% do not, 5% unsure. Good. This is actually going, I hide this now? Okay. This is going great. I'm glad that everybody, not everybody, but most of you do own your bin and ICA. For those of you that don't, you can call me afterwards, but the typical thing is often you may be dissuaded by your processor, because I'm not going to sugarcoat it, but the processors have deals with either MasterCard or Visa. I can tell you right off the bat. Co-op, MasterCard is, now let me say up front, they will support both, but there are some that are favored over others. TMG MasterCard, Co-op MasterCard, I know Co-op and TMG are one, CSCU FIS Visa, PSCU Visa, Vantiv MasterCard. So they will try and push you a certain way, because then they get kickbacks. What do we get? We don't know. Not what do we get, what do they get? We don't know, but there is something there. Okay, now this is going to go to all of you who are principals, okay? You need to determine how your settlement occurs, because in your processing contract, it may be that you settle through the processor. And the way you identify this is on your card processing invoice. Are you seeing these big line items at the end of every quarter that says quarterly Visa dues or quarterly MasterCard dues, and it's just a line item with no backup? Or are you seeing all the Visa fees that on a monthly basis, or MasterCard fees on your processor invoice with no backup? That means you're settling through the processor. You don't want to settle through the processor, especially you larger credit unions out there. You can settle directly with Visa, and that is what I recommend. That's where you're going to get your gross interchange, and then the fees, and then the net. We don't want our members' money going through any more parties than it needs to go through. And where this often gets, you think you're a principal member, yes, we own our BIN and everything's going great, but then it comes down to settlement, and settlement is a clause in your processing contract that you really want to review and make sure that it's doing what you expect it to do. And I just feel everything should come to the credit union. Okay, when you are ready, you want to find out what your effective interchange rate is. You can take a picture of this screen, but you can even do this for the end of the year. Do end of 2016, do year to date, but identify the amount of interchange that you received / booked into your system, divide it into net sales. Net sales are described as just purchases less returns. Cash advances do not earn interchange, so do not include them in this calculation. It is just purchases less returns. And then you'll get your effective interchange rate, and that is the number you want to be 1.68 to 1.72. When we do this in my schools, there are some credit unions out there that are 1.4, 1.5. I am seeing more and more are getting that 1.6 range, but you need to, it sets off an alarm if your interchange is lower than 1.65. But that'll give you some idea whether you should be comfortable with your interchange being received, which then has to do with your affiliation with Visa versus MasterCard and your processor and owning your BIN and not. I'm hoping all this is making sense. I'm trying to go through an entire day of training in an hour-and-a-half webinar. Okay, we are going to be going through expense management. All right. Sorry, I just have to have a pause here. Your card program expenses that need to be included for any annual net income analysis. This goes back to that page that I showed you, the spreadsheet in the beginning, to get to your annual net income per account. As a reminder, our income comes from finance charge interchange fees. The expenses that need to be included are your processor expense, your pass-through fees and dues from MasterCard, your cost of funds, which you can typically get from NCUA through your 5300 report that your accounting department filed, your plastic bond coverage, gross charge-off credit card loans, and that typically also will include fraud charge-offs, your credit card marketing expense if it's not already built into your invoice, your plastic expense, credit card salary, and reward redemption expense. So that's the general list. Take a photo of it, put it on Instagram. Now your charge-off expense, and this is again sometimes when I differ from CFOs, oh my God, our charge-offs are creeping up to 2% and we're taking too much risk. It's fine if they're 2%. It actually, those programs are more profitable. But it's only good if your average credit line is $7,500, your average balance is greater than $2,600, and your annual net income, which includes charge-offs, are still greater than $75. What I'm trying to point out here is don't get fixed on any one certain ratio going up or down or income going up or down, because there's a lot you can do behind the scenes to make it work. Okay, we have questions. Oh, Eileen is asking, can you allow over the limit to a certain amount or percent of credit limit? Typically, yes. It tends to be, most processors do offer the option of allowing to go over a dollar amount or go over a percentage. My recommendation is always do it on a percentage, and that would be the same with credit line increases. You want to make any parameters that are based on, you want to make the parameters to make sense with the credit line. So you may allow somebody with a $5,000 credit line to go over 10%, and that would be $500. But you wouldn't want to give $500 to somebody with a $1,000 credit line. So if you do the percentage, it's more spread out. And Myra is asking, can you repeat the definition of net sales again, please? Yes, net sales would be purchases less returns. It does not, and that's for interchange calculation. Do not include cash advances in interchange calculations because interchange is not received on cash advances. Kimmy Davis is asking, do you know what the average e-statement penetration percentage is? We are actually getting to that momentarily, so just stick with me, Kimmy, because we're going to go through some of the expenses, and we'll address that. Remind me to address that one. Okay, so with that, if you don't mind, we're going to move on. This is the fun part. Processor expense. Okay. How many times do you think you're being ripped off by your processor? Or are you paying too much, or whatever? I've been in this industry, as I mentioned, since 1985. I've had this business of my own since 2003. And yes, oh, you can't combine line item by line item. It's apples and not apples, and it's oranges and lemons, and you can't compare the two. So over the years, I have come up with a calculation. This is my calculation. It is not sourced anywhere. This is Ondine Irving and the 600 credit unions that she's analyzed over the past, 13 years. But through all my research, I have determined, and this was actually lower last year, when you're looking to kind of get an idea, are you getting ripped off? Did you get a good deal? Perhaps you took that $200,000 sign-on bonus and things are kind of, getting up there again. If you are a full service client, and when I say full service, you process with CSCU, FIS, TMG. I'm going to keep calling them TMG. It's still not in my head, but TMG, PSCU, or Vantiv. You should, for EMV, should be paying an annual expense ranging from $30 to $35. Now, if you're pass-through with Jack Henry, Co-op, even FIS has a pass-through environment, it should be $18 to $22 per year. But I want to remind everybody that if you're processing pass-through, and we're talking just about the pass-through processing invoice, you would still have to incorporate your cost of plastic, postage, embossing, statements, all of those things that you do outside of the in-house processor. Prior to EMV, the annual processing expense per account should have been 24 to 28 full service, and then pass-through was 12 to 18. So those are some benchmarks for you to kind of get an idea, and that's on your to-do list at the end of the webinar. So within that 30 to 35, the annual processing expense per account per year. Did I have something to show? No. Okay. That should include all of these basic things: communication methods, authorization, transaction posting. It's basically everything to get your program running. That's 30 to 35. Now, you may have rewards and your expense may be higher, but you're still making an annual net income of $75, so you're fine with that. But your basic processing costs. What I want to go over here, these are the things that make your processing expense kind of get out of control. EMV, but I've actually changed that because I've increased the fee. But loyalty programs, merchant funded, and others, including redemptions. But again, I wouldn't worry about it if your program is profitable. These are things to look at. The cardholder alerts. Surprise, surprise, that's becoming an add-on product. Card controls, online banking, marketing services, which include the direct mail, letter checks, activations, enhancements, training, enhanced cardholder servicing, which means that somebody may answer the phone that says, "Hi, this is so-and-so from Baxter Credit Union. You know, they'll do it with your name. Extended statement reporting history, design a card, color statements. Now, who the heck wants color statements these days, which are double the cost of regular when everything's online and you're trying to push everybody to e-statements? So those of you that have color statements right now, get rid of them, because, you know, if you've got them online, those are pretty expensive. Customization of programs, letters, correspondence, and analytical data and tools. So your exercise, your APE per account, and that, I looked at that, I thought I had a typo when I was reviewing it. It's like, no, that's right, that's account processing or annual processing expense per account. Take a picture of this. Now, what you'll see on your invoice, and I'm going to try and go off my memory here, there are some processors that are so good with their invoices. If you have debit, credit, and ATM, they actually subtotal each category. But you want to find out, however you need to do it, get through accounting if they're booking it right, but you want just your credit card processing expense, divide it by the total of accounts on file at the end of last year. I recommend doing 2016, and come up with your annual processing expense per account. So that's one step, and that's going to give you an idea. And my point is, if your processor is not summarizing your product categories on your invoice, they should. Who does a really good job with the invoices on this part? The organization. FIS, PSCU, I'm trying to think. Vantiv does a good job with their invoice. And the others are hit or miss. Not to say the information's not there, it's just harder to analyze. Okay, so this is what I recommend everybody to do, and I teach this at my schools. Okay, you need to analyze your invoice. Just don't get it. Sign it on the bottom because the amount looks like what it was last month and there's no big variance, and let's just send it to accounting. Everything is done via ACH anyway. But the way to do this is you need an Excel person. You need a spreadsheet geek. And you get an Excel spreadsheet, you get your processing invoice, you start inputting the categories, and then start ranking. And I've got a sample to show you here. And hold on, got to put my glasses on. Handouts. Am I going to handouts? Yes. Okay. I am going to show you sample invoice spreadsheet 2. Woohoo! I hope y'all can see this, but this is actually from a client of mine, and I took out the name, obviously, but I broke down their invoice, excuse me, into an Excel file, and I took the summary page, as it's shown here, and came up that this credit union in 1 month paid $32,534.54 for credit card processing expenses. But right away I'm saying, okay, half of that is credit card services, but 39% is value added. What the hell is that? It ends up being rewards. Then we've got association dues. But check on that $32,534. At the very bottom, I've got the $32,534. And then what I did is I ranked the categories from highest to lowest, and you can do that in Excel and sort it. Well, clearly this credit union, 31% of their entire expense was rewards, which is most likely redemptions, and that's fine if the program is profitable overall. But I ranked, so it kind of gives me an idea where to look at the invoice for potential cost savings. If we scoot down to the bottom here, the estimated annual processing expense was $390,000 a year. They had 7,100 accounts on file. So I had the pleasure of telling this credit union, you're paying close to $55 per account per year on file. So that, again, that's just one piece of the information. We had to go back and see if the program was profitable. The credit union might be very good with that. I wouldn't be, but they might be. We can see that a lot of it was in redemptions. Elliot, help me close that one and pull up the sample spreadsheet invoice, this one. I've got another one coming here. Okay, this is another one. This was a credit union. Let's go to the bottom. $64,000 a month. So up to $768,000 a year for 19,000 accounts. This credit union was paying $38.97. So I am tasked with, okay, I need to find this credit union some savings. So I took all of the categories and sorted them, and we had data exchange being number one, transaction fees. These were the categories that I started looking into, and yes, I did find cost savings for this credit union. But this is stuff you should be doing as well. You know, it sounds like I'm banging up on the processors, and I'm not. You signed the contract. If you're not managing it, that's not the processor's fault. But the reality is that fees do increase year over year. So what you might have been quoted 5 years ago may not be what we need to get rid of that. Might not be what you're paying now. Okay. Where are we? Okay, so beware of account-based billing fees. I will tell you, if you're in a full-service environment, CSCU, FIS, TMG, PSCU, Vantiv, you will have numerous account-based billing fees where, and this can be advantageous in some areas and a disadvantage in others. When you have account-based billing fees, the nice thing about this is you have many low costs spread out among the card base versus the a la carte fees that, you know, may come up and you've got no control how high they go, meaning cardholder calls and things like that. But if you do account-based billing fees, you need to make sure that you've got somebody managing the database because, as I mentioned before, 40% of typical cardholder bases are inactive, and if you're paying, say, 10 different fees on each account on file, that can add up. So those are one thing that you want to go through your invoice and check for. The sources of cost savings with excess accounts on the system, and this applies to debit and credit. And I've saved credit unions, you know, $10, $15, $20, $30,000 a year, and it doesn't sound like a lot for a year, but you add that up over the 5-year contract, it adds up pretty quick. But the excess accounts on the system, closed accounts, lost, stolen, upgraded, replacement, get those off the system. And I want everybody to be aware of this rule. I'm getting dry again. Processors, there's a rule that Visa and MasterCard have out. They are auto-purge criteria. And accounts will eventually auto-purge from the system, but the expiration date must have passed and there can be no activity for a year. So let's say somebody reports a lost stolen for an account that was just issued last year, doesn't expire till 2020, you issue them a new card. That card that you blocked lost stolen, unless you tell them to purge it, it's going to stay on the system, and yeah, you could be paying on that account until it purges, which this is where you've got to really take it into your own hands and manage the portfolio and the database. This is a killer. This just came up especially with a large client of mine who wanted me to review. They're with a processor, they just did a conversion, and they're doing their first reissue. And they said, Ondine, will you take a look at our reissue criteria? I said, sure, send it over. And they sent it over, and it had the delinquency data. And I said to Alex, I said, so where the heck is the activity data? He said, oh, well, there isn't any. Well, we went back to the processor because we don't want to reissue accounts that have not had any activity for 12 months. We don't want to reissue, in my opinion, 6 months. We don't want to reissue accounts for cardholders that never activated their card in the first place. And the fact that the activity level was not included in basic reissue criteria really, really surprised me, that that was above and beyond, that the credit union, yeah, well, they can request it, but, you know, you've got to do this, this, this. No, that should be basic information. Now, think about this. That's how processors make their money, is by issuing accounts, the plastic, embossing, the postage. So it's in their best interest to issue as many as possible. So I want everybody on this call to get with your processor and say, I want our reissue criteria and I want to see what it is. Ensure you're okay with the reissue timeline of inactive accounts. And then 2 to 3 years is typical for the expiration of a card program, regardless of the EMV expense. And one of my clients, I was just shocked. They put a 5-year expiration on their plastic because they said, well, it's the EMV cost. And I said, okay, you're looking again through a tunnel. You can have, save money there, but what are you risking because you're not scoring the cardholders and adjusting their rate? So you want to work with that reissue timeline in a relatively conservative way. A recent job with another credit union, the standard reissue criteria, when processors have default numbers to use because you're not sure what you want to put there. Well, the standard default was 99 months of no activity. If there's been 99 months of no activity, yeah, we'll still reissue a card. So do me a favor and check your reissue criteria. This is a big one, and it is with several processors, and in fairness to them, I am not going to name them on this phone call, but it is a full service processor. There are 2 of them, and they charge by the cardholder call. So you need to find out from your processing invoice, are you paying by the phone call, or is it being spread out across the account base as one of those account-based billing fees, which in my recommendation is that's the way to go, because there's no way to control the number of phone calls that come in, especially if there's a data breach. But more importantly is whose phone number is on the back of the plastic, yours or the processor? And what about the cardholder statements? Which phone number is there? Never, ever, ever place your phone or the processor's phone number on the plastic. That goes for debit or credit. It goes back to the BIN ownership. It's your program. Your name is on it. Everything about that program should be you. Should you ever want to convert to another processor and everything else is in your name, just don't put the processor's phone number. So you can have the calls come to the credit union and then distribute accordingly with your tree, your phone tree. So we are going to do the very last poll. Okay, which phone number is on the back of your plastic? Yay, look at this. Uh-oh. Well, we were at 100%. That's okay. All right, we're going to close the poll. We're going to share. And here, good, 80% of you have the credit union's phone number. The others have the processors. For those of you that have the processor's phone number, my recommendation is the next time you do a reissue, or if you have a conversion coming up in the next go around, ensure that that is taken care of. How do I lose the poll? Hold on. What's our time? 2:30. All right. If you don't mind, I want to get through, we've only got a few more slides to get through, then we'll go through all the questions. Other sources of cost savings is reporting. The report line items are huge on processor statements. The statement, record retention, and cardholder notes. You may not know this, but typically you're charged a higher price for longer retention, and there's different categories. You may want to retain cardholder statements for 6 months, 12 months, 18 months, or notes on accounts, 6 months, 12 months, 8 months. The pricing varies. So typically they will always put you, based on what you input in your parameters, to start off with, they'll put you in the most generous category until you get where you need to be. Verified by Visa and Master Secure Code, that is, you can get rid of it. Nobody's using it anymore, and it's not required. It's one of those cash cows for Visa or MasterCard. People at my schools, credit unions, have told me that the insurance companies no longer require verified by Visa or Master secured code. And the other source of cost savings, when you see the line items on your invoice, MasterCard, Visa pass-through line items, get the detail. If you're seeing a charge come through that has $12,392.73 as a line item, and it happens to be 25% of your invoice, say, yeah, give me the detail on this. And once you get the detail from Visa or MasterCard, if you can get it, because if you're an affiliate, you won't be able to get it, that's where you'd see all the warning bulletin and all the Visa MasterCard fees that are typically hidden. One thing that I mentioned that I failed to mention during this webinar is, especially with the invoices, make sure you got to go back to basics on this. Don't try and review it on your screen. You take the invoice, and yeah, it may be 30 pages. Trust me, I have printed up more invoices than I care to. But print the darn thing up, get yourself one of those bright yellow highlighters, and you need to just start going through the line items and identifying the big ones. Put it on a spreadsheet. Start sorting. See if you're paying more than $30 to $35 full service annually per year. But these are all the things that I want credit unions to do, because sometimes it is just, and I don't mean to be mean, but sometimes it's mismanagement of the portfolio by the credit union, and then the members are suffering because it's not as competitive or as credit union friendly as it could be. That's the bottom line. And hold on. So here, I want to go through your to-do list, then we're going to get to questions. I'm not going to go into detail because we're running short on time. But here's your to-do list. Take your cameras out and take pictures of these. You want to calculate your income allocations, and this is what it should be. You want to verify your key portfolio statistics, the average lines, balances, and utilization. You need to do an income audit. Find out about your minimum pay and grace pay. Your credit card interchange, you need to do that audit. Do an over-limit fee income potential. And find out if all of the miscellaneous fees on your disclosures, if you're truly collecting them. 95% of the time, credit unions aren't collecting them. Risk management. Are you scoring card holders at reissue or other? Are you scoring them regularly? If you're not, tell your CFO, you know, hey, we're not scoring. Our lending department isn't scoring, and we want to talk about rates here. Your BIN affiliation. You need to find out who this is, or who owns your BIN. Are you an affiliate or a principal? You know what I forgot to share with you? Hold on. I want to show you all this. This is a sample BIN license agreement. Why is that not coming up? I want to show you guys this. Everybody here should have one of these. There it is. This is out of my manual. See this Visa BIN license agreement? And it shows the account range and who owns it and what kind of, you know, it is. The bottom line is every issuer should have one of those on file. So part of when you say you know you own it, get a hold of this Visa BIN license agreement. Okay, how do I get rid of that? And same with MasterCard. So back to number 6, you call them, get a copy of your license agreement. The processing expense, calculate your expense, make sure it's 30 to 35, and obtain a hard copy of the processor invoice. And I'm sorry that's so little, but this is where I mentioned, go through with a highlighter, spreadsheet your expenses, sort the expenses high to low, and then if you've got a spreadsheet Excel geek, which I'm one of those, but if you've got one on staff, do it every month and have them develop a monthly tracking so you can see the trends. Getting down to the last one, we have processing expenses, a reminder, find out what your annual processing expense per account is. And gee, here's that other one that is larger. Get the hard copy of the processor invoice. So with that, I'm going to take a break. I'm not taking a break. I wanted to put in this webinar too, I wanted to put the friendly refresher from Card Wars episode 1, where we went through all of the portfolio management, just for anybody who's new, so you can see what the key stats should be for your program. You can take a picture of that. And so with that, we are going to get on to questions. And I want to just share one thing with everybody, okay? I had a dream, just like Martin Luther King. And gosh, this has been going on for 1.5 years, and I have been very picky and anal about this, and so that's why it hasn't launched, but it's ready to launch on my website. It's going to be launching August 15th. I'm creating a membership discussion forum because there have been requests out there from my clients, my school attendees, webinar attendees, and I wanted to create a place where everybody could come, no matter who you process with, and share good stories about organizational structure, pricing, profitability, marketing, management, operations, all kinds of things, anything and everything card related. So this is coming up, and I am doing an offer just for my webinar people, because I've only been doing webinars a short time, I think like 6 months. This is my second one, and I'm really enjoying them, and I'm getting great feedback. But what the membership is going to include is you're going to have access to the member discussion forum, and it's like a little Facebook. You've got an avatar. You can ask questions to the entire community in whatever section. You will get 3 free webcasts annually, and as you know, they're $249 each. You'll get 10% discount to the school, and then you'll get this online. And so the regular rate's going to be $9.95, and I took that after my fearless idol, he's not an idol, mentor is what I meant to say, Rex Johnson. And then when we roll it out to the credit union community, and many of you may or may not know this, I recently retained Sarah Cook. She was the former editor of CU Times. She started her own consulting company, and I jumped at the opportunity. But what she's developed, and we've talked about, the regular credit union community, if they're one of the first 50 to register by August 31st, $7.95. Bottom line is, all of my webinar attendees, and I'll be sending you an email, you will get this for $4.98 for the first year, which includes 3 free webinars and everything else, because you guys have been good to me and you've stuck it through, especially the last webinar when we had a few hiccups. But we'll send that to all of the webinar attendees before we launch to the public. And so with that, questions and answers. Will you read them? I think I'm exhausted. This?
Okay. Do you find areas to reduce expenses right before a contract is ending, or can this be done during an active contract?
Hold on. Not sure do I find areas to reduce expenses right before a contract ending? You should do it at any time. Oh, but you're talking about if it's a contractual expense. Yeah, the contract, it is what it is. Whatever you signed or your management signed 5 years ago, that is what it is. Where I do find most of the cost savings is typically, hate to say this, but it's on behalf of the credit union, because no one is managing the expense or the program, or they're looking at parts in isolation. But I would do it now, because it may not be the processor's fault, it might be your fault. Not you, but the credit unions. Okay, I'll read this. Okay, since we are in our first year of our credit card program, would it be expected that our annual processing expense per calculation is high? If so, at what point should it level out? We have 1,000 cards on file after 10 months. That will go back to, it depends on your contract. If you were given any bonuses, incentives, or sign-ons, or if you had to pay out of your own pocket for the conversion expense, the EMV reissue, I think what you should do is you're in the first year, I'm assuming that's in 2016, I would, excuse me, 2017, I would wait until the end of the year. Doesn't mean you can't start looking at the invoices, but start developing a spreadsheet, get one of the paper invoices and start spreadsheeting it and see where you are right now and then see how that changes over the next 6 months. What is an acceptable purge period, 3 months or 6 months? Pretty easy. Lost, stolen can be weeks because they have been reissued with another card. When you're talking about, let's say, just closed accounts or inactive accounts, it gets a little more complicated there because when you start talking about closing accounts and purging, and if the account has the member's credit score and they're not, let's say, it gets a little complicated. Amy, if you email me, I'll send you the section of the manual that tells you how to sort through all that. Andrea, will you be bringing a school back to San Francisco? Not in 2018. I wish. We had so much fun in San Francisco. We were there in May. We will be coming to California. We do Vegas every year. That's in January. We will be somewhere in California, but my gut is we're looking at San Diego, possibly Napa if it's not too expensive and not too hard to get to. But we will be in California. Just I doubt it'll be San Francisco. Does anybody have any other questions? Oh, Myra, purging cards can also have an impact on transactions coming in after the card is off the system. We found that researching the account becomes a challenge. And you're absolutely right, but you've got to look at the impact. Is that what they're saying? You've got to look at the impact. I mean, if you've got a and Myra brings up a good point. If 40% of your accounts are inactive, and let's say you've got a 10,000 account portfolio, you're talking about 4,000 status accounts lost, stolen. And yes, it may make it challenging to research that occasional account, but you've got to offset that with the expense of keeping it on the system. So this is something where that membership forum that I'm coming out with next month is going to be really helpful, because then credit unions can share with each other what works for them, because what works for one credit union doesn't work for the other, and you can have that open discussion. So yeah, I personally like to keep things very clean and tidy, and there are extremes. I mean, some credit unions have never purged because collections doesn't want to purge, and some are just purge happy. You know, hey, if you're not using our card, then we don't want you around. Oh, Kimmy, could you address my earlier question about e-statement penetration? Yeah, and this is, okay, let me put it this way. No, I don't know the answer because it's still relatively new. From what I have seen from invoices that I am going through with credit unions, it's like maybe 20% of a portfolio is getting e-statements. And it's funny you bring that up, because when you start going through your invoice, you don't think the processors know about this. A lot of them are charging more for e-statements than they were regular statements. So go figure that out, because they know that they're going to lose some income. But mostly what I've seen is about 20%. And that would be on the high side. Kimmy, can you respond? Do you offer e-statements, and where are you? All right. Well, yes. Indiana. Oh, no, not where are you? Yeah, no, I know where you are that way. But where are you with e-statements? Do you know what your penetration is? Less than 5. Yeah. Oh, it's okay. Yeah. I'm at that point too. It's like, okay, it's been a long webinar. But yeah, you can always check with me and I can share more information. But with that, we've lost 10 people from the audience. I want to thank everybody. The remaining of you here, thanks for joining us. Thanks for being supportive. I hope it's been helpful. We will get the recording. Last time we didn't get a recording because that was the password issue and all that stuff. But we'll have this recorded. I will send a link out to everybody when it's available. We will send copies of the slides. I'll do that from my end. It's just a PowerPoint, and we'll go from there. And the next webinar is going to be in October. So with that, I thank everybody, and we'll talk to you soon. Thank you. Bye.